So again, thank you everyone for attending. Just a really quick intro to Foundation Source and who we are. We are the nation's largest provider of comprehensive support services for private foundations. As you can see here, we were founded in 2000. So we've got 20 years under our belts of managing private foundations. We're headquartered in Connecticut with a national footprint. We have over 1,650 private foundation clients and over 150 employees. We administer over 16 billion in foundation assets, and we have over 7,100 users of our online foundation management tool. Additionally, we've processed over 342,000 grants totaling $5.8 billion. And from a retention standpoint, we have a 98% client satisfaction as well. So just to touch on some of the services that we offer, you can really look at this in 3 pillars. What our services are meant to do is to allow your clients to focus more on their mission, their strategy, and your priorities rather than on administration. So we like to say that we do everything to enable our clients to focus on their philanthropy and enjoy their philanthropy. So there's really 3 pieces to what we do. There's administrative support, there's expert advice, and there's online management tools. And all of those come together, again, to provide these comprehensive services to private foundations. So from an administrative standpoint, you can see that we take care of accounting, compliance monitoring, transaction processing, tax prep and filing, and financial and grant reporting. And we really leverage our expert advice and our experience of managing private foundations for 20 years to really provide that level of expertise to our clients. That is all tied together with our online foundation management platform called Foundation Source Online. This enables our clients to do online research, make grants online, track their assets online, track their reporting, and really just take care of their foundation from a grants management standpoint. And you can see here from the bottom, the result from these comprehensive services are better run foundations, and we like to promote greater social impact. So as far as partnering with advisors and attorneys, our services are complementary, not competitive. So we're here to work with you to help your clients with their philanthropy and with their grant making. We handle the ongoing compliance monitoring and administrative services that legal and financial advisory firms typically don't. So if desired, we can assist with foundation creation out of the state of Delaware, the IRS Form 1023, get foundations ready for funding in less than a week. We work behind the scenes directly or indirectly with clients, their attorneys, and their advisors with all documents before submission.
And we'll start today's presentation. So first, let's just cover the basics. Since every foundation grant, whether made to a for-profit or to a not-for-profit, must always serve a charitable purpose, we'll go over the various purposes that are considered to be charitable by the IRS. We'll also go over the concept of intended beneficiaries and how a grant to a for-profit organization reaches through the grantee to the real object of the grantor's largesse. And as you likely suspect, a foundation must proceed with caution when there is a for-profit organization in the picture. We'll go over the concerns regarding these kinds of benefits that might be conferred upon private interests and how we can mitigate these concerns. And in the same vein, if a grant to a for-profit organization is not handled with care, the foundation can inadvertently incur a steep penalty called taxable expenditure. And special procedures are needed when granting to a for-profit organization. We'll go over those as well. The very specific set of foundation procedures that a foundation has to follow when granting to a for-profit organization to avoid a violation and a penalty. And lastly, we'll review a handy list of questions that a foundation should be sure to consider when contemplating a grant to a for-profit organization. Okay, so let's talk about the elephant in the room. How can a tax-exempt charitable organization like a private foundation, how can it make a grant to a for-profit organization? In these situations, though, the key is to remember that the for-profit organization is merely the vehicle, the tool of the foundation, that the foundation uses to accomplish its broader charitable purposes. Of course, like the for-profit itself is not intended to be the beneficiary of the foundation's largesse, again, just its instrument, just its vehicle. Accordingly, it's really important that the foundation clearly articulate the specific charitable purposes to be served by making a grant to the for-profit and identify those who really are intended to benefit from the grant. Now, let's talk a little bit about charitable purposes. At first glance, it might seem like it goes without saying that the grant must serve a charitable purpose, and it might even seem like a no-brainer to be able to meet that requirement. Although it may be relatively easy in some cases to conclude that the purpose being served indeed is a charitable one, it's not always so straightforward. In fact, there can be cases where the activity seems like a worthy cause, but it may not pass muster under the IRS's rules. And why? It's because whether something is charitable or not is not a personal subjective judgment. Rather, the judgment is one that's made by the IRS, which looks to a body of precedent and regulation to determine whether a particular activity is charitable. One of the first times I ran into this on a personal level was we had a client that was very eager to make a loan to an organization that was set up in Vermont as one of these L3Cs. That's the subject even for another lecture, but the point is an L3C is a low profit, limited liability company. They're not so popular nowadays. And the idea was that this L3C was formed for a bakery that was going to specialize in artisan fruitcakes, and virtually all the profits from the bakery activity and from the sales was going to go back into a food pantry for the neighborhood. And that obviously seemed like a charitable activity. But according to the IRS, the way they look at this, they look at whether or not the activity itself is a charitable one, not what you do with the money, but how you make the money. And essentially, there's really nothing inherently charitable about running a bakery. Now, it might have been made charitable if they had maybe had some sort of apprenticeship program to teach people how to be bakers, or maybe if they hired people from an underserved class or whatever, but that wasn't the case. It was just run like an upscale bakery, and there was nothing inherently charitable about that. And ever since then, I've certainly taken to heart, and I know those clients take to heart, that when you think about something as charitable, you have to think not about what a regular person would say, but what do you think the IRS would say? Okay, now you have to also take into account that the grant purpose, again, must be one that the IRS considers to be charitable under its body of precedent, as we've talked about. And according to the code, what you're looking at now on your screen is a list of the high-level charitable purposes that for which a 501c3 organization may be operated. And you'll note that charitable is listed as one of the many purposes, but that term itself is really kind of vague, because if you ask 10 different people what does charitable mean, you'll probably get 10 different answers. Fortunately, though, the regulations shed some light on what is meant by charitable. Now, in the 501c3 regulations, the IRS provides a list of specific activities and purposes that it considers to be charitable. Some are pretty intuitive, but others really not necessarily so at all. For example, it might seem obvious that providing relief to the poor will be considered charitable, but one might be surprised to see that maintaining public buildings would also fit into the IRS's definition of charitable, the advancement of religion, and these other various things that you see listed here, neighborhood tensions, combating juvenile delinquency, defending human and civil rights, and the like. those are not so obvious. So assuming that we've satisfied ourselves that the purpose of the grant will be considered charitable in the IRS's eyes, the next thing we'll want to do is consider, who does the foundation actually intend to benefit from the grant? Who's the charitable class? And so, as we'll learn shortly, in addition to determining and defining the class of intended beneficiaries, it can be just as important to determine whether anyone outside of the targeted group will benefit. If so, who and how much will they benefit in proportion to the intended beneficiaries? And in the coming slides, we'll go over a case study. We'll learn about some of the compliance issues that can arise with grants to for-profits, how to avoid those problems, and we'll reference our case study throughout to help illustrate the concepts. Now, let's say the foundation makes a grant to a for-profit caterer to provide free meals to children attending a particular school in a disadvantaged neighborhood. Here, the caterer, the for-profit organization, is the instrument, the vehicle that the foundation will use to achieve its ends of providing free meals to children who otherwise wouldn't be able to afford them or have them. And so as far as the unintended beneficiary goes, again, obviously the foundation is not intending to enrich the caterer with the grant funds. And additionally, it's likely that not all of the kids, if you think about it, probably not every single kid attending the school from a disadvantaged neighborhood necessarily comes from a disadvantaged household. It's possible that the foundation works with a for-profit to provide meals to all the kids at that school. Inevitably, some kids from families who are not suffering a financial hardship and therefore are not the intended beneficiaries of the grant may benefit as a result. So let's keep this in mind as we review the compliance concerns. So under 501c3, charitable organizations are required to operate exclusively for charitable purposes. However, exclusively doesn't actually mean exclusively. A charitable organization may in fact engage in an insubstantial amount of non-exempt activities. And further, the regulations indicate that an organization isn't going to be considered organized as or operated exclusively for charitable purposes unless it serves a public rather than a private interest. So if you put all that together, if more than an insubstantial amount of a 501c3 organization's activities further non-exempt purposes, what is the upshot? It's that the charity can lose its tax-exempt status. Therefore, a foundation should conform as closely as it can anyway to the IRS's ideal of serving public rather than private interests. Additionally, the regulations specifically address activities that could cause a foundation to lose its charitable status if those activities were a substantial part of the foundation's overall activities. If a foundation makes an expenditure for an activity like that, the regulations, specifically 53.4945-6, provides that the foundation will be subject to a 20% taxable expenditure penalty. Under the private benefit rules, any benefit to private parties must be incidental and must be outweighed by the benefit to the public at large. The IRS has taken the position that insubstantial here means incidental, and that a two-part test must be applied to determine whether in fact any private benefit here is incidental or more than incidental. Under this two-part test, any benefit to private interests must be both qualitatively and quantitatively incidental. So what does all that mean? And by the way, you'll read a million articles on this and you'll read a million treatises, and no one explains it exactly the same way. But I'm going to try my best to roll it up and make it understandable. So in order for private benefit to be considered qualitatively incidental, the primary benefit, here's the key, the primary benefit must flow to the public at large. and any benefits to private interests must be unavoidable, a necessary byproduct or concomitant, as the IRS put it, to achieving the organization's charitable objectives. So in thinking about whether any incidental benefit to unintended beneficiaries is it really unavoidable or not, you have to examine the benefit to the for-profit organization as well as the unintended beneficiaries resulting from the grant. In other words, we're looking to see to what extent the benefit is bleeding or leaking over. So you're benefiting, presumably, the people who you're trying to benefit, the intended beneficiaries, but we're going to look at the spillover. Who is going to benefit aside the for-profit, as well as those like, the kids in the school who didn't need the free meals. So when we conduct the analysis, we're going to look to see whether any benefit conferred on these private interests is no more than necessary, is an unavoidable byproduct to achieve the foundation's charitable goals. So part of the analysis in applying the qualitative test now is to determine whether or not the benefit to the for-profit organization goes beyond just the reasonableness of the amount of the grant. So as a preliminary matter, I'm saying it's important to consider whether the for-profit is it really the best vehicle for achieving the charitable purpose. For example, would the foundation's charitable goal be better accomplished by making a grant to a public charity? In some cases, a for-profit might be the best choice because of superior experience, track record, qualifications, lower cost, higher quality, even if a charity could also carry out the program, albeit not as well. And on the flip side, in the event that a nonprofit grantee would be equally effective while conferring less private benefit than a grant to a for-profit organization, I suppose you could infer that the foundation should choose that nonprofit grantee for the benefit to be qualitatively incidental. After all, to the extent that private benefit can be reduced but isn't, then the portion of the private benefit that could have been avoided but wasn't can't be considered a necessary byproduct of the activity. So assuming that the for-profit, in fact, is the best organization suited for the job, another consideration would be whether a grant, as opposed to a loan or equity investment, would be the best approach. I mean, if you think about it, if you're making a grant, what you're doing is that you're giving the money away. Again, when you're making a loan or an equity investment, you're not actually giving away that money because you're carrying an asset on your balance sheet. You're expecting to recoup your investment. So you're not giving the money away itself, like as with a grant. In those cases, with a loan or equity, what you're giving away is merely the use of the money, not the money itself. So in any event, a foundation shouldn't be compelled to choose a less effective option for achieving its charitable purposes, just because that other option might confer a lesser degree of private benefit. For example, while again, a loan or equity investment might provide a lesser benefit, it may not be the best option. Why not? Well, because maybe the for-profit doesn't earn enough, doesn't have enough revenues to service debt or pay dividends. Also, if you have a private foundation investor in the mix, it might scare away other commercial investors. A lot of things you have to take into consideration. So revenue ruling 70-186 provides a very helpful example of how to apply the qualitatively incidental test to a given scenario. So in that ruling, an organization was formed to improve the condition of water in the lake that was available to the community as a recreational facility. It had a polluted lake, it had a beachfront open to the public, but while the benefit definitely would have and obviously benefited the public at large, it would also benefit private owners of lakefront property by increasing property values. The IRS concluded in that case that the private benefit was incidental in a qualitative sense because the benefits would flow to the general public, and such benefits couldn't be attained without necessarily benefiting the private property owners. Like it was an unavoidable product. You couldn't byproduct of cleaning the lake. You couldn't just like clean half the lake. Either you clean the whole lake or you don't clean it at all. So now let's think about how we would apply the qualitative test to our school lunch case study. So here we'll need to apply the test to both the caterer, the for-profit caterer, and to the students at the school who are not disadvantaged, as both are intended beneficiaries, spillovers of the foundation's grant. If the foundation exercised reasonable judgment in determining that its charitable goals would be best achieved through a for-profit caterer, and by making a grant as opposed to a loan or equity investment, then conferring some benefit to the for-profit caterer would likely be seen as unavoidable. And as for the kids at the school who don't truly need the meals, the foundation has to consider whether the benefit provided to them is an unavoidable byproduct of the program. Well, suppose that the school insists on providing the meals to all the kids in the school because it would be administratively burdensome to keep track of those kids who would not qualify for the program, as given the demographics of the neighborhood, nearly all the kids would be eligible. In that case, the benefits of the small group to the small group of unintended beneficiaries would be a necessary byproduct of the program, because the school in that case otherwise wouldn't agree to run the program. And as earlier mentioned, an activity must also be quantitatively incidental, which involves a weighing of the private benefit against the public benefit. So in conducting this weighing, as it were, the IRS has acknowledged that the greater the public benefit, the more private benefit will be tolerated. Therefore, the foundation should minimize the benefits to the for-profit to lighten one side of the scale, as it were, to make it more likely that the benefits to the public will outweigh any private benefit to the for-profit. And we'll touch more on this later, but one way to do this, again, is to ensure that the foundation grants no more than a reasonable amount in exchange for the value furnished by the for-profit in terms of goods, services, and other possible concessions. And as with a qualitative test, the quantitative test has to be applied to both the for-profit and any other intended beneficiaries. Revenue Ruling 76-152 provides a very good example of how the quantitative test should be applied. In this ruling, an organization was established to promote community understanding of modern art. And the organization selected modern artworks of local artists for exhibition and for sale at its gallery. On sale of the artwork, the artist received the sales proceeds after paying the 10% commission to the organization, noting that the artists themselves weren't members of the charitable class intended to benefit, who was intended to benefit the people in the community who were supposed to develop a greater understanding of modern art. Again, the artists themselves weren't the intended beneficiaries. So looking at the benefit to the artists, the unintended beneficiaries, the ruling concluded that private benefit to them couldn't be overlooked as being merely insubstantial in relation to and despite the public benefit conferred by the exhibitions. Now, in the context of the school lunch case study, again, as I said, local demographics should ensure that the number of unintended beneficiaries should be greatly outweighed by the number of intended beneficiaries. In this scenario, the public benefit, again, would outweigh the private benefit, even if the free lunch is provided to everyone. And then if an affluent neighbor, if that's where the case were changed, so instead of deploying this program in a disadvantaged neighborhood, if it were instead set up in an affluent neighborhood, you could achieve the objective by insisting that the free meals be limited just to those who are in need of them. So the general rule here is that all private foundation expenditures must be for charitable purposes. That's really, ABC 1, 2, 3. And some types of expenditures are flat out prohibited by congressional fiat, like those involving lobbying, electioneering, and voter registration drives. That being said, there may be a fine line between permissible activities and those that flatly are prohibited, like the difference between permitted advocacy and nonpartisan voter education on the one hand versus prohibited lobbying and electioneering on the other hand. It could be very nuanced. While a foundation can freely make grants to charities classified by the IRS as public charities, without any special oversight or terms, grants made to other types of organizations generally are permissible only if certain rules are followed. For example, grants made to domestic or foreign organizations that are not public charities can always be made by following special procedures collectively known as expenditure responsibility. And these procedures generally entail due diligence, special grant letter terms, annual reporting to the foundation of the grantee's expenditure of the grant funds until they're fully spent, and the foundation's reporting of the grant on its own annual return. Both the quantitative test and the taxable expenditure rules require that the foundation pay no more than a reasonable amount in exchange for the goods, services, and other benefits received from the for-profit. The foundation regulations provide that an expense payment in excess of the fair market value for those goods or services may be subject to a taxable expenditure penalty unless paid in a good faith belief that the expense was reasonable and consistent with ordinary business care and prudence. In addition, the foundation has a fiduciary duty of care to negotiate fair value in exchange for the grant, so it doesn't waste corporate assets. The foundation has to consider, what is the going rate for the quality, the quantity of goods or services to be provided in connection with the grant? It appears at first that the foundation is not receiving fair value. If that's the case, then what should the foundation do about it? Well, it should try to bargain for concessions from the for-profit to make up and for the difference on the economically to tip the scales. For example, a foundation making a grant to a pharmaceutical company to develop a vaccine that may require the company to make the vaccine available at affordable prices and in geographical areas that the company might otherwise not find profitable. Those are concessions that will help the foundation achieve its goal of making this drug available to all who need it, regardless of their wealth. In the context of our school lunch study, the foundation could try to bargain with a for-profit caterer to lock in rates for meals for an extended period of time, maybe to provide healthier meal choices, larger portions, etc. So again, here's the analysis again, just kind of summing up what we covered. And I think it would probably be a really good idea for a foundation making a grant to for-profit to kind of go through these questions and maybe make a document its reasoning when it rules out private benefit and determines that everything's okay. So these are the kinds of questions and the answers to the questions that should ideally be part of its records. So again, qualitatively incidental. Is a private benefit, is it unavoidable? Is it an unavoidable concomitant of the grant? And in terms of quantitatively incidental, there's the weighing going on. Does the benefit to the public outweigh the private benefit? Is a program designed to maximize the benefit to the intended beneficiaries, to reach as many people on the public benefit side of the scale and to lighten the scale and minimize the benefits to the unintended beneficiaries? Is the foundation receiving fair value for goods and services? And if not, what concessions can it obtain in bargaining, negotiations with a for-profit to tip the scales and make them at least more even? You see here kind of a quick overview of the stakes. If you have a taxable expenditure, if there's too much private benefit in any particular grant, or if you don't exercise expenditure responsibility as you should, again, it's 20%. And with that, we come to the questions.
Thank you very much, Jeff. We do have a question from one of the attendees here. Before we dive into the questions, just a couple of housekeeping items. So everyone's aware, we will be sharing the slide deck with all of the attendees as part of our follow-up. In addition, we will be sending out a video replay of this session tomorrow morning as well. So you can expect both of those items. And then lastly, in the dashboard section of our GoToWebinar, you'll see a handout section where we do have a few handouts for everybody. There is a piece that talks about program-related investments. We have another brochure that highlights Foundation Source and the services that it offers. And then we have another piece that talks about how we work closely with attorneys and law firms. So there are a few PDFs that you can download directly from the handout section. So with that, I will jump into the question, the loan question that we received. And the question is, Jeff, with cutting down on private enrichment, keeping that in mind, do I have to choose a not-for-profit instead of a for-profit?
So again, not necessarily. Again, the IRS certainly acknowledges the possibility that the foundation may use a for-profit instrument as its vehicle for accomplishing its charitable objectives. You could see evidence of that, by the way, in the program-related investment regulations. So for those of you not familiar with a program-related investment, or PRI, those are investments that are not made to achieve an economic return, but to achieve a social return on your investment. They're typically loans or equity investments, and they have to meet a number of specific rules. And the IRS illustrates how they could be used with a number of examples involving loans or equity investments and for-profits. And in many cases, it wraps up the analysis of why something is okay by concluding that, again, the pharmaceutical, in one case, very similar to the one that we talked about, there is a pharmaceutical company. It was developing an orphan drug, and as an incentive concession, the foundation made sure that the pharmaceutical company would in fact market the drug at affordable prices in areas that otherwise would not have been considered profitable. So anyway, the idea is the foundation has business judgment to determine whether or not the for-profit is really the right instrument and whether or not they're getting fair value. So again, I would suppose that the prudent thing to do in terms of documentation will be to solicit bids, perhaps from different organizations. If there's a nonprofit, sure, include the nonprofit and get a bid from them, and maybe other for-profits. In the catering example, maybe they're not-profit caterers and other caterers. And again, I would probably get at least 3 bids and look at the quality and everything. And at the end of the day, you need to make a business judgment. And to the extent that you make a business judgment, you're not going to be cornered into choosing an option that's less effective at achieving your goals just because maybe it'll provide a smidgen less private benefit. If in your business judgment, that's the best way to get it done, all things considered, and you've gotten bids to rule out unreasonable private benefits so that you could say, yeah, I think this is a reasonable price, they're the right way to do it, then you're not coerced into choosing the nonprofit. You can go with the for-profit.
Beautiful. Thank you very much, Jeff. We don't have any other questions. Actually, one more. I just got one more question that came in. So we have someone asking for any tips for submitting a new grant proposal to the IRS for approval.
A proposal to the IRS. I mean, maybe they mean or a private letter ruling, perhaps. I'm not sure if that's what they mean. But again, what I would do in a case like this with a for-profit, I have a tick list. I go through the tick list. I document the questions and the answers and why someone reasonably could conclude that this was the best choice, the best way to get the job done, that the benefit to the unintendeds was unavoidable, and that the benefit outweigh to the public outweigh the benefit to the private person. So you're cutting down on private enrichment.
Perfect. Thank you, Jeff. It looks like that is it for questions. Did you have another slide or two to wrap up our session today?
Well, again, I could spend another second or two on the taxable expenditures. I want to point out that with respect to a taxable expenditure, someone might conclude, it's worth paying the 20% freight, as it were, of the penalty because I want to get my job done. I want to make the grant. So the thing is that if the IRS catches on that there's a problem here and there's any kind of an assessment, the IRS can insist that it be corrected. And if it's not corrected, it can result in 100% second-tier penalty. Not only that, but there's even a penalty, but the penalty is paid by the foundation for the most part. And the thing is, when it comes to what about the foundation managers? And it shows that if they know that this would be a taxable expenditure and that's a problem, and they do it anyway, even though it's a higher bar than for the foundation itself, because with respect to managers, you have to show mental intent of some sort. But even they could be personally responsible to some degree and subject to penalties for knowingly making a grant to any kind of grant that's a taxable expenditure. So again, it's always important to know the stakes. And so, Steve, I think that concludes the presentation, unless there are any more questions that have rolled in.
There are no more questions in the queue. So thank you again, Jeff, and thank you all for attending. If anyone has any additional questions, please feel free to email us at webinar@foundationsource.com. And again, you can expect a copy of the slide deck and a replay of this session tomorrow morning. So thank you again for joining, everybody. Have a wonderful day.